current liabilities. So, and this is one thing to remember. You need to list in order, the same order as your balance sheet, the assets that the order in which you list the assets and liabilities on the statement of cash flows is the same order as your balance sheet. So we're adding so the first one, accounts receivable. Next one, supplies expense. Next one, prepaid expenses. You say, wait, you skipped over short-term investment. Well, short-term investment is an investing activity. Remember, on the cheat sheet, lesson 10, but the bottom, the concepts of definition from lesson 12. All right, investing activities are the purchase and sale of securities, right? So this short-term investment, that's a security. Well, we're not including that in this it's changes in assets and liabilities because that's an investing activity. We're only interested in operating activities right now. Okay, then we list accounts payable, unearned revenue, and accrued liabilities. Now you're saying, well, what about stockholders' equity, long-term debt? Long-term debt, that's a financing activity. We're only interested in operating activities right now. Okay, so that's how I've listed them. You need to list the assets and liabilities in the same order they appear on the balance sheet. All right, moving on. So accounts receivable increase. That C, where do we get that from? Right here. It's in red. Wait, an increase in a current asset we subtract from net income, right? So we subtract it from net income. That's why there's parentheses. Anytime you see parentheses in the financial statements, it's a negative. All right, so it's in red. We subtract it from net income. There, it's a subtract. Supplies expense. Go over here to D. D. It's red. It's an increase in a current asset. We need to subtract it from net income. Subtract it. Prepaid expense increase. All right, it was an increase in prepaid expense. What do we do when it increases? We subtract it. Accounts payable. Accounts payable increase. What do you do with an increase to a current asset? You add it to net income. So we add it there. Unearned revenue. It's an increase. What do you do when you increase a liability? You add it to net income. Accrued liabilities, same thing, an increase. Add it back to net income. All these are referenced from where they're coming. So D is over here, G is over here, H is over here. And so we're just taking the change from our balance sheet, adding it into the statement of cash flows. Now, when you add all those up, that's our net cash provided by operating activities. Remember over here to the left, we said we start with net income. Okay, we did that. It's there. Losses and gains. There were none. Ignore it. Non-cash expenses is depreciation. We added depreciation. Changes in current assets. We did that. We got that from the balance sheet. There. That equals cash flow from operating activities. Right there, $300. That's our cash flow from operating activities. Now, let's talk about cash flow from investing activities. Okay, going back up to short-term investments. Remember I said, oh, that was an investing activity? Well, let's include that in investing activity. What did we do? That decreased. What do we do with a decrease in an asset? Remember, we add it. Go back over down here to the bottom. When an asset decreases, we add it. All right, so that's a positive. Next, purchase of machinery and equipment. Well, where did we get that? The change in machinery and equipment. Remember, going back to the lesson 10 cheat sheet at the bottom, there's concepts and definitions from lesson 12. Investing activities is the purchase of property and plant and equipment. That's an investing activity. Okay, so if machinery and equipment increased, we must have bought it. It must have been an investing activity, and we must have paid cash. So we subtracted. That cash went out the door. But with maturities and sale, that went down, so we must have received that cash at some point, right? That's why we're adding it. So net cash used in investing activities, $74,900. All right, move down to cash flow for financing activity. Okay, proceeds from long-term debt. Remember, Round Belly, they got a note payable for 25 grand. Okay, well that must have increased our cash, right? We got that note payable. Increased cash right there, 25 grand. Net proceeds from stock issuance. Remember the first thing we did on the balance sheet is Round Belly was incorporated. They issued stock. In exchange for that stock, they got cash. Cash went up. Increased the cash. So we added. That's $100,000 is our cash provided by financing activity. All right. That's how you get to your statement of cash flows. Now, what do? You take so you sum the net cash provided by operating activities, the net cash used in investing activities, the net cash provided by financing activities. You add those all together. The net increase in cash and cash equivalents was $25,400. That is the same change that we had up here on our balance sheet. It's mechanical down here, but it needs to equal that same change. Imagine that. Now what do? We add that change to our beginning cash balance. Our beginning cash balance we get from our prior period, or in our comparative balance sheet. Remember we had a comparative period. Well, the cash balance of that comparative period, we need to add the change to that balance, and then we get to our ending cash balance. Our ending cash balance, going back to Lesson 1, when I was talking about the interconnection of the balance of the statements, cash from the statement cash flows needed to equal the cash on the balance sheet. Look, 26,300. That equals our cash, 26,300. We've successfully created a statement of cash flows using the indirect method for operating activities. Now, let's get into statement of cash flows for the direct method. The direct method is different. The direct method, we're only interested in 4 things, right? It's cash collected from customers, cash payments to suppliers, cash received or paid for interest, and cash payments for income taxes. Those are the only things we're worried about when we're calculating the direct method. Remember, if we do the direct method, we have to also do a reconciliation to the indirect method. So I don't know who would ever want to do the direct method, because then you have to do 2 statement of cash flows. They're hard enough to begin with. Why would I want to do 2? Anyway, we're going to go through the direct method right now. So I've only included the operating section down below our statement of cash activities on lesson 12 cheat sheet. I've got a separate cash flow, but it's only the direct method and it's only the operating, because financing and investing activity is the same whether you use direct or indirect. All right, so this is only the operating activity portion. Now you see I've referenced cash collected from customers 21,350, cash payments to suppliers is 21,100, cash received for interest was 50, and cash payments for income taxes was 0. Those I've calculated down below. So how did I get those? Net sales. Net sales, where do I get that? You get that from the income statement. That's one of the 3 things you need to come up with a statement of cash flows. Alright, so I've listed net sales here. Increase in accounts receivable. Increase in accounts receivable, why would I include that? Well, I must have received that cash from a customer, right? Okay, so conceptually think about this. If I make a sale, I'm going to receive cash. Unless I give credit terms, right? Unless I say, here's a good, pay me later, give me the cash later, so I wouldn't have received that cash, right? So I'm only interested in cash transactions right now. So that's why I'm including my accounts receivable, because that must have mean that I've deferred a payment or I've received something from the prior period in this case. So my change in accounts receivable I include here. Also, I include my change in unearned revenue, right? Because even though I haven't recognized revenue and I haven't given the service to the customer, I got their cash. Remember, we did a couple examples for Round Belly, a gift certificate, and then also one where we did a deferral, like they were having a December 31st, a New Year's Eve party. Well, that cash I received from my customer, I may not have recognized revenue, I may not have performed the service, but I received the cash. So I need to include it here because this is cash collected from customers. All right. So when you add all this together, so you get 21,350. That goes to my direct operating activity statement up here. Now, SG&A. Okay. So how do I calculate my cash payments to suppliers? Well, I take my SG&A expense. SG&A is selling, general, and administrative expenses. You'll see that called, those are your operating activities. Those are all the activities that sustain your business. All right. Well, so if I'm sustaining my business through expense, remember, like utilities was one of the expenses and rent was one of the expenses. All right, well, those are all things that I'm paying to suppliers or paying to vendors. Those are all things that are sustaining my business. So that's my starting point. Operating expenses, SG&A expenses, 14,400. I got that from my income statement. That's my starting point. Now I need to include like things that I didn't pay, right? So, things I did pay, increase in supplies. I must have paid somebody for those supplies, right? I haven't used them yet. I haven't recognized the expense. Remember lesson 3, when you go through, you incur a cost, right? You pay cash. Well, is that asset going to benefit a future period? If yes, if it's a future period, you book it as an asset. If no, you expense it right away. Well, these supplies are going to benefit a future period, so they're not included as in my operating expenses, but I've paid cash, so I need to add it here as a cash payment. Also, my increase in P-rate expenses, remember I paid rent, I prepaid insurance. Well, those, even though I haven't recognized expense, I've paid cash. Remember, cash flow statement, we're only interested in cash payments. So if I paid cash, I need to include it here. Now, in this case, my accounts payable increase. Accounts payable increased. I received a good, but I didn't pay anybody yet, right? So if if my accounts payable increased, I must have not paid any cash. So I need to subtract that out, because although I've received a good or a service, I haven't paid for it yet, so no cash has gone out. So I need to subtract that from my SG&A, my increase in supplies, my increase in prepaid expenses. Also, my decrease in accrued liabilities. Note, this decrease. Okay, this doesn't tie to the change in accrued liabilities because remember the four things we're interested in the direct method. It's cash collected from customers, cash payments to suppliers, cash received for interest, cash received from income taxes. Well, if you go back to lesson 4 where we're creating our balance sheet, and we had that little bracket that says what goes into accrued liabilities. Well, what goes into accrued liabilities? Things like accrual for income taxes and accrual for interest. So I'm breaking those out down below here. So the math may not work, but if you go through and you subtract the balance of interest and you subtract the balance of your income tax payment, the math will work, all right? But anyway, so that's $1,500. It decreased. So if our accrued liabilities decrease, I must have paid something. I must have paid somebody. So that cash went out the door, so we need to increase our total cash that went out the door. Now, that is $21,100. That goes up to our statement of cash flows, the direct method, operating activities. Now, I have my interest expense, and I have increase in interest payable. So, interest expense, increase in interest payable. I must have received some interest because my interest expense was $150, and my increase in interest payable was $200. So I must have received some interest, right? So that's right here. That's why it says cash received for interest. Now, income taxes. I haven't paid any income tax. My income tax expense was $2,600, but I haven't paid it yet. I've recorded a liability for that, so no cash has gone out the door. So that nets to zero. That's why it's up here, included in zero. Now, when you add up the $21,350, you subtract the $21,100 and the $50, you get $300. $300 is the same as our indirect method. They have to equal because it's the same cash going out the door. It's the same information. It's just presented differently. All right, that's the indirect and the direct method for the statement of cash flows. Listen, I went through that pretty quickly. It's a hard concept to grasp. Trust me, this was one of the hardest things I learned when I was an accounting student, was trying to figure out how to calculate a statement of cash flows. You may need to watch this lesson multiple times, but the first thing is to understand mechanically how this statement works. Mechanically, you subtract the current balance on the income statement against the comparative period. That's going to give you your change. The change, that goes into your indirect method equation here. Mechanically, just understand how it works. Now, I've included some financial ratios here, that common financial relations relating to your statement of cash flows. Capital acquisitions ratio, that just shows how you're using your cash to buy property and equipment. Cash coverage ratio, that just says you're collecting this much cash and this is how much interest you paid, so this is how much interest in the future you'll be able to pay based on your cash flows coming in. Quality of income ratio, that just says you may be making all this money. Say your revenues are up, but if you're not collecting any cash, well then that quality of revenue is not very good. That's what that tells us. In lesson 13, I'll go into more depth about each of these ratios, but that's lesson 12, statement of cash flows.